Most people think the stock market is a giant casino where you bet on the next hot tech stock, hoping to strike it rich overnight. But the wealthy, the 1% who actually keep their money, look at it differently. They don't look for moonshots, they look for engines. Engines that produce cash flow while they sleep. Today, I'm going to show you exactly how to build a $100,000 dividend engine. We aren't just talking about numbers on a screen. We're talking about building a machine that pays your bills, funds your lifestyle, and eventually buys back your freedom. But here's the reality check. Building a 100K portfolio isn't just about picking stocks. It's about a radical shift in your financial DNA. It's about moving from a consumer mindset to an owner mindset. While the average person is excited about a 5% raise at work, the dividend investor is excited about a 5% dividend hike that they didn't have to work a single minute for. In this deep dive, we'll break down a battle-tested 4-pillar strategy. We'll look at the exact ETFs and stocks that can turn $100,000 into a monthly cash machine, the hidden traps that wipe out amateur investors, and a 30-year projection that will change the way you look at a dollar bill forever. If you're tired of trading your life hours for paper money, listen closely. This is the blueprint for your exit strategy. Before we talk about specific tickers, we need to talk about the secret sauce that makes this $100,000 work like $1,000 over time. It's called DRIP, Dividend Reinvestment Plan. Most amateurs make the fatal mistake of taking their dividend checks and spending them on a fancy dinner or a new pair of shoes. That is financial sabotage. When you spend your dividends early, you are essentially killing your money babies before they can grow up and have babies of their own. By activating DREP, you are automating wealth. Every time a company like Coca-Cola or Realty Income pays you, that money is instantly used to buy more shares, even fractional ones. This creates a feedback loop. More shares lead to more dividends, which buy even more shares. Think of it as a snowball at the top of a mountain. At first, it's small and moves slowly. But as it rolls, it picks up more snow, gains mass, and eventually becomes an unstoppable force. In a 100K portfolio, DRIP is the difference between having a nice side income and building a multi-million-dollar empire. You aren't just investing money, you are investing time and consistency. The market doesn't pay the smartest people, it pays the most disciplined ones. Now, let's build the machine. To survive any economic weather, inflation, recession, or stagnation, we divide our $100,000 into 4 distinct pillars, $25,000 each. Pillar 1, the anchor, broad market ETFs. We put our first 25K into an ETF like SCHD, Schwab US Dividend Equity. Why? Because it's a filter. It only picks companies with strong cash flow and sustainable payouts. It's the safe haven of your portfolio that provides steady 3 to 4% yields with solid capital appreciation. Pillar 2, the dividend aristocrats, the immortals. The next 25K out goes into the aristocrats, companies that have raised their dividends for at least 25 consecutive years. Think PepsiCo, PAP, Johnson & Johnson, J&J, and Lowe's, LOW. These are the titans that survived the 2008 crash and the 2020 pandemic without missing a single payment to their owners. Pillar 3, the monthly cash machine, REITs. We want consistency, so we allocate 25K to real estate investment trusts, specifically Realty Income CIRT. Known as the monthly dividend company, they pay you every single month. It mimics a rental property without the headache of tenants or leaking pipes. Pillar 4, the dividend growths, the future giants. The final 25K is for the aggressive growers. These might have lower yields now, around 1 to 2%, but they grow their payouts by 10 to 15% every year. Companies like Visa, V, or Microsoft MSFT. They ensure that your income doesn't just stay steady, it outpaces inflation by a mile. Now, listen closely, because this is where most beginners lose their life savings. The financial markets are crawling with honey traps designed to lure in the greedy and the uninformed. The biggest trap is the yield trap. You see a stock boasting a 12% or 15% dividend yield, and you think you found a gold mine? Think again. An unnaturally high yield is often a distress signal, a red flag that the company is in deep trouble. If the stock price plummets 50% while they pay you a 10% dividend, you aren't winning, you're bleeding out. Remember, the safest dividend is the one that was just raised, not the one that looks the highest on a screener. The second trap is sector overconcentration. Never dump all your $100,000 into one single industry, whether it's tech, energy, or real estate. If that specific sector hits a regulatory wall or a recession, your entire cash flow evaporates overnight. And finally, the silent killer: emotional tampering. When the market turns red and the headlines scream, "Crash," your lizard brain will scream at you to sell everything. But a true dividend investor smiles during a downturn. Why? Because when prices drop, yields go up. For us, a market crash is just a giant store-wide sale on the machines that print our money. You don't sell the cow just because the price of milk dropped for a week. So, let's get real. What does this $100,000 actually buy you in the real world? Let's look at the hard data. With the 4-pillar portfolio we've built, you are looking at an average yield of roughly 3.5% to 4%. This means your 100K engine is generating between $3,500 and $4,000 per year. Broken down, that's about $300 to $330 every single month. I know what you're thinking. 300? That's not a Lamborghini lifestyle. But look deeper. That $300 covers your high-speed internet. It covers your car insurance. It covers your basic grocery bill for the month. These are the mandatory bills that you no longer have to trade your life hours for. You have effectively liberated a percentage of your month from the 9 to 5 grind. You are partially free. And because we've diversified across companies that pay in different months, like O paying monthly and SCHD quarterly, this cash flows into your account like a steady heartbeat. Every 30 days, like clockwork, your employees, your dollars, report for duty and deposit their earnings back to you. You aren't working for money anymore. Money is officially working for you. But here is the part that will keep you awake at night: the sheer power of time. What happens if you don't touch that $300? What if you use that drip engine we talked about to reinvest every single penny? In 10 years, through the power of dividend growth and reinvestment, your 100K has swelled to nearly $300,000, paying you roughly $1,000 a month. In 20 years, the math starts to get vertical. You're sitting on nearly $900,000, and your passive income has jumped to $3,000 a month. But in 30 years, this is the holy grail of finance. Your portfolio crosses the $2.7 million mark. Your monthly dividend check, over $10,000 every single month. Think about that. Over $10,000 a month without lifting a finger. That is the reward for the discipline you show today. That is the price of your ultimate freedom.